Weighted average cost of capital, capital asset pricing model. What's the idea? I want to estimate what? What did we just say? To do a present value, what do I want to estimate? Yeah, so I'm going to get an estimate of my cash flows. I'm not kidding. And then what am I going to do with that estimate of cash flows? I'm going to discount it. And what you do, instead of taking it times 1 over 1 plus the interest rate raised to infinity, because that's what it'd have to be. This is cash flows to infinity, right? Instead of taking it times, we could take that estimate of cash flows times 1 over 1 plus whatever our discount rate is, right? By the way, what's our discount rate going to be? What do we use? You guys read this. What's it going to be?
Pure interest.
What's it going to be? What the hell are we doing here? I'm getting estimated cash flows. I said we were going to use the weighted average cost of capital and the capital asset pricing model. What is the weighted average cost of capital? It's the weighted average cost of the capital. What's the capital? Your liabilities plus your equity, which I think is your total assets. It's the amount you must earn on your assets. That's your weighted average cost of capital. You know why? Because you have to give your debt holders what they demand, right? That's the cost of the debt. And you have to give your equity holders what they expect, right? In order to justify your stock price, which is the cost of the equity. And then we we take the weight of the debt times the cost of the debt, plus the weight of the equity times the cost of the equity, and guess what we get? The weighted average cost of both of them, which is what? The weighted average cost of the assets. It's how much we have to earn on our assets. To do what? Keep our debt holders happy, pay them, right? And what else? We have the shareholders the return that they expect based on our stock price and our CPI. Oh, that's all it is. You guys read this, didn't you? Oh, and it says that, honest, right? It says that. Read it again. This one you want to read a few times and think about it. And I know it just sounds like a story about this girl, right? Young woman, whatever. Old one. I'm old too. Okay, anyway, what's the deal? It sounds like just a little story, but there's a lot of information in it, you guys. Okay? Get the idea. Get the theory of this. So anyway, you know what that's going to be? It's not going to be, I'm not going to call it any longer. All right, okay. There. I'm not going to call it 1 plus an interest rate, a discount rate. I'm going to have 1 plus WACC, because that is my discount rate. Weighted average cost of capital, my discount rate. Okay, because it's what I have to earn. But you know what? Instead of writing it like this, instead of taking estimated cash flows times 1 over 1 plus WACC, what I can do instead, you guys, I'm still right. I'm hitting the wrong thing there somewhere, aren't I? There it is. That's it. I'm going to do this instead. I'm going to take those estimated cash flows What did I hit wrong, do you think? Why is it doing this? Oh. Anybody have a suggestion? That should be letters. That should be a pen. Piece of crap. Did I do the same command without knowing? Yes, I did. I've never had this. This is the same thing I had happen downstairs too. Doing something weird that it doesn't like. This is what we've done. Sure. We'll give up if this doesn't load. Okay, what we're going to do is we're going to take our estimated cash flows. My estimate of cash flows is forever. It's always going to stay the same, right? When we start with this. And then I'm going to divide it by WACC. Here's the deal. Let's say my estimated cash flows are $100,000 per year. And I divide them by 10, say my WACC's 10%. What's going to be 0.1 into 100? That would give me my estimated market value of my assets. Okay, what would that number be? $1 million? Everybody agree? It's true, isn't it? Isn't it true that 1 million times 10% is 100? Everybody agree? Okay, this is simple math, okay? Now let's think about what this means, though, just intuitively. If I had $1 million invested in assets, and I'm going to earn 10% on it every year, how much am I going to earn every year? The 100. If you took the 100 out now, because now you had $1 million and you earned 100, so you have $1,000,001. If you take the 100 out, what do you have left? The million. The million will still be there, right? And then if you earn 10% next year, how much will you earn? 100,000. And then what? If you take the 100,000 out, what do you have? $1 million. And then you invested 10% again. Get my drift here? You'd get 100 forever, wouldn't you? If you had $1 million investment and you're earning 10%. So what we do, that's true, isn't it? It's just true no matter what the numbers are. Okay? So what we're going to do is we're going to say, look, if I have my estimated cash flows and I divide them by the WACC, that must be what the assets are worth. It's got to be, right? Because I could take my assets times whatever that percent is and get my cash flows. It's just that I know the cash flows first, and I know the WACC first, and I'm estimating the assets. Okay? So take a look at this. Do you get that intuitively? It makes sense. Some number invested in assets, if it earns a certain amount every year and we take it out every year, you'll still have the same amount of assets, right? Okay? And then we don't have to do the mathematical proof, which is really nice. Okay? You just get it intuitively. Okay. So the estimated cash flow is divided by WACC. What did the formula say? It said what? That is what? Your estimate of the market value of the assets. And that everything is in market value, you guys. Everything's in market value. I could care less what historical cost is of the assets. When I buy stock in a company, I do not think I'm buying the historical cost of the assets. What if they've had their land for 30 years? You think you actually get to buy your share of that land when you buy stock, right? Your little piece of the land when you buy the stock. Do you think you get to pay the historical cost, or do you have to pay the current market value? What do you think? You got to pay the current market value for everything, don't you? Everything sells for the current market value, not for historical cost. I don't care what historical cost is. Okay? We're not using that. We are using market values here to value things, of course. That doesn't mean historical cost isn't valuable. It gives you some information, right? Finance people. Okay? So, all right. Anyway, you will have finance people that didn't get much education in accounting tell you all the time that accounting's worthless because it's historical. Try and do finance without financial statements. Good luck. Impossible. Right? It's not worthless. It's just not very valuable. How do you like that? It's all estimates. It's not very valuable. All we got is estimates, you guys. So our estimated market value of the assets is based on our estimated cash flows and our estimate of WACC. You like it so far? Here's an estimate based on two estimates. Okay, and then you know what? What we're going to do is we're going to subtract the estimated market value of the liabilities from that. And guess what that will give me? I mean, you don't have to think too hard for this, you guys. I bet it is. I bet you assets less liabilities is equity. And I bet if they're both at market value, the third one will be at market value. How about that? That's very good. Okay? Estimated market value of the equity. Of course it is. That's not something you memorize. That's obvious, isn't it? Now, that's the estimated market value of all the assets, because these are all the cash flows from all the assets, right? And this is the weighted average cost of capital percentage you're supposed to earn, right? So that's the estimated market value of all the assets, not just your share, okay? And this is all the liabilities, so guess what? That's the estimated market value of all the equity. I want to know what it is per share. You got it. Formula says, of course, number of outstanding shares, but that's only because it's obvious. And what I want you guys to do is think this is obvious. See why I don't care if you memorize this or not? You have to know it anyway. What's to memorize? Okay? So what do we have over here? Whoops. It's a dollar amount, of course, but I don't want to put dollars on there. Yeah, estimated market value per share, isn't it? That's it. Okay? That's it. This is hard to do, easy to understand now. What's hard to do is to come up with these estimates. Okay? So what do I need to get this process started? I guess an estimated cash flows and WACC, huh? Everybody agree? Okay. So there's what we're going to try and do. All right? And I guess we could start. I don't care which one you do first. Doesn't make any difference. What's the estimate of cash flows that the paper suggested? By the way, we didn't make all of this up. We just wrote this out. Famous finance fellow, comma. Estimated cash flows. The theory starts back in okay. Estimated cash flows. What is it? Okay, which is a better estimate of future cash flows? The cash flow on the cash flow statement or the net income? What do we say? What's a better predictor of future cash flows? Accrual basis net income or cash flow from cash flow statement? Which one can you manipulate really, really easily? You can have more cash by just not paying your bills. Right, guys? You can not buy assets, you can sell assets, you can borrow more money, you can really manipulate cash flows. So, what's hard to manipulate? We call it GAAP. Financial income. So we think that financial statement income is a better predictor of future cash flows than the cash flow statement. So the finance approach to this thing is what? Estimated cash flows equals what? What does the formula say, you guys? You can look at the paper where we're doing it. I hope you are. Okay, what do you think? It's attached to your syllabus, right? Okay. What do you think it is? What's estimated cash flows? It's right there. Look at page 11 of the handout I gave you. Projected annual cash flows is what? Yeah. Okay. It's net income before tax, but you know what? You don't want to just take net income before tax. It's very naive, right? Don't just take the number. Make sure it's net income you think is going to continue normally, right? Forever, I guess, but normally. Make sure you pick up the right net income. So what if they have some unusual items, unusual gains and losses? They're either unusual or infrequent, but not both. Are those included in this net income before tax? Yes. I'd take those out of it. What if they recur over and over, though? Every year they're there. Oh, they're not unusual or infrequent, either one. You got the idea? So just because it's a non-operating doesn't mean I'd take it out of there, but I'd think about it, right? I want a normal year. Okay, so net income before income tax from a normal year, times what? Times what, you guys? They say income from operations. I think it's more than operations. It's whatever income you think is going to continue into the future before tax, right? Times what? Of course, it's 1 minus the tax rate because the government gets part of it, right? The taxes, and you get to keep 1 minus the taxes. Everybody knows that, don't they? Right? Okay, pretty straightforward, pretty simple. I want a normal tax rate too. I don't just want the most recent year. If the most recent year isn't representative of what most years are like, I want the normal one for the company. Make sense? So you guys are going to have to do a little thinking on this when you analyze financial statements. That's where it gets hard. Okay? You're looking at a real financial statement here, which is what we're going to be doing. I will, for a quiz, I'll give you a real company, and I'll say, do it. Here's the company name, go do this. Right? And you guys will all disappear and go find the computer someplace and do it, and bring it back to me. And I will get a different answer from every single one of you, and I've got a little spreadsheet I plug them into, and I see if anything you did makes any sense whatsoever, and try to give you some points. Or maybe some of you will have a really good estimate. I'll use that for the key. I actually work for myself. It's real fast. It's real easy. By the way, can you build a spreadsheet to do this? Of course you can. Can you use it in a quiz or a test? Please don't. Please actually do it, okay? Right? Because I want you to have practice doing it a few times too. But if you want to build a spreadsheet for this school, that'd be great. Okay, no problem. And will I give you mine? No. Richard Schrader taught this class for a while, and I sent him my spreadsheet, and he gave it to the students, and I said, why did you do that? They're just plugging numbers into the spreadsheet. They're not learning how to do it, right? And so, he says, well, I thought you did. So, anyway. All right. I don't give students anything. You guys know that. I try not to teach you anything, so it makes it harder for you. Okay, anyway, I'm pretty good at that. I was talking to Dan Bauer about that today. So net income before tax times 1 minus the tax rate. Okay, now that's going to give me what? My share of the net income, right? But you got to add back what? Well, non-cash items to your income statement, huh? So what do we add back? What's the biggest non-cash items? So finance types like a simple formula, so we kept it simple. You can get more sophisticated. What are the non-cash things? Depreciation and amortization. They're big and they're usually together. By the way, where do you find those? You can find them on the income statement sometimes, but usually not. Because they get split up into cost of goods sold if it's a manufacturer, might be buried in some operating expense someplace, but where is it always? Where do you always see depreciation and amortization? Come on, you guys. Where is it always? Not on the balance sheet. That's accumulated. Don't use that one. And don't just use the change in accumulated depreciation because you might have retired some assets, right? Don't go there. Oh, come on. Where does it show? Every single time we add it back. We add it back to the net income on one of the statements, just like we're doing here. Have you in this room ever done a cash flow statement? What do you add to your net income? You add back non-cash items like depreciation and amortization. It's always on the cash flow statement. It's usually the second line, right after net income. There's add back depreciation and amortization. You can always find it there. I'm a dismal failure. Okay, anyway, like always. Depreciation and amortization, so it's really easy to find. Now, why don't we add back the depreciation and amortization before we take it times 1 minus the tax rate? What happens because we have the depreciation to our taxes? They go down. It's one of the expenses that got to our net income, right? We took all our revenues, less all of our expenses, and we got net income before tax, didn't we? All of our expenses except for tax. And then we take away the tax and we get net income, no. So that depreciation expense reduces your tax bill, doesn't it? So you want to leave that in there so you get the tax benefit of it, don't you? Why do we add it back? What's the journal entry for depreciation and amortization? Debit depreciation expense, credit amortization expense, and credit what? Accumulated depreciation and maybe various assets that you're amortizing, right? You guys right? Are you ready with this? How much cash goes out in that journal entry? Debit depreciation expense, credit accumulated depreciation. How much cash is there? None. The cash is when you bought the asset, or at least when you paid for it, right? Everybody agree? So we're adding back the depreciation and amortization because it didn't take any cash, but we do it after we take out the taxes. Why? Because we get a tax benefit from it. It's called a depreciation tax shield. Anybody in the tax class heard that one? Not yet. You will? Okay? Corporate tax. Okay? It's a depreciation tax shield. If I have $100,000 of depreciation and a 40% tax bracket, how much taxes did I save? 40,000, right? How much of the cash went out to get my 40,000 tax savings? Zero, right? Depreciation expense didn't take any cash. I just get a 40,000 benefit, right? Of course, it's 5,000. Okay? You guys know this, don't you? Yeah, maybe. All right. Is there anything else? This is too easy, isn't it? That's this number right here. That's it, isn't it? There you go. That's what we're going to do. Where are we going to find the net income before tax? I think it's on an income statement. We're going to use real income statements, okay? We're going to use real income statements. Where are you going to find the tax rate? On a real income statement. There's 3 years on large corporations, right? Publicly traded corporations, 3 years. You can compute 3 tax rates real easy. It's the tax expense divided by the income before tax. You don't even have to do that. In the notes of the financial statements, they almost always tell you what the tax rate is, the average tax rate and the marginal tax rate. You want the average, okay? For this purpose. Marginal if you add an additional dollar. Okay? Yeah, that's all that's going on here. Okay, so what else do I need to make this start working? WACC, right? What's WACC? Weighted average cost of capital. Yeah, the weight of the debt. It's going to be the weighted average cost of capital. The capital is the debt plus the equity, which is your total assets. I know accountants say capital is equity and we say debt is debt, but really they're both sources of capital to run the business with, debt and equity, right? They're both investors. Would you agree the bondholders are investors in the company, really? Mortgage holders are investors in the company, really? Yeah, they are, right? Sure they are. We just call it debt, okay? All right, weight of the debt times what? Cleverly. Cost of the debt. And we use K, you know why? Because in economics, C means consumption. So we use K. Right? So nobody thinks it's consumption. Okay, I guess. Weight of the debt times the cost of the debt. Times what? It's the other component of our total capital. Equity. Weight of the equity. Times what? Cost of the equity. Is this intuitively obvious or what, that that would be the weighted average cost of the assets? Huh? Weighted average cost of the capital? If what you have to pay the debt holders is going to be after tax, because the government gives you a tax break for the interest, right? Times the weight of the debt. And then the amount the shareholders expect to earn, which is KE, right? Cost of the equity, times the weight of the equity. This ought to do it, huh? It ought to give you your weighted average cost of capital. That's the whole model. Not true. Where do those numbers come from? I got to keep going. So it's not quite as easy as I pretended. Well, that's nice. What I did there. Weighted average cost of capital. What do I need? What pieces do I need to get it, guys? Because once we have that, we can divide it into the estimated cash flows and get our estimated market value of the assets. We're on our way. How do you get, well, what do you need? Weights and the cost. That's it. So what do I do for my weights? Let's do the weighted debt and weight of equity. What would I do?
Total liability divided by total assets.
That would work pretty good. They give me the weight of the debt. Right? Everybody agree with that? Let's start with, and what would you do for the weighted equity? Yeah, you got it. Now be careful. Are you going to use book values? I started out with this. I don't care about historical anymore. Take off your accountant's hat. As an accountant, I still don't care about historical. It's just the best estimate we've got right now. Right? It's most reliable that we have. And it's useful, right? See how old an asset is and that sort of thing. But what's the deal? What do I care about? The market values. So what do I want? I want the market value of the debt divided by the total assets. That's what I really want. And I want the market value of the equity divided by the total assets. And of course, for the total assets, I need market value of the assets. So it's like this. Assets equal liabilities plus equity. And then what I'm going to do is I'm going to take the liabilities and divide it by the assets and take the equity and divide it by the assets. I'm not kidding. But I want the market value of each. So how do you estimate the market value of the liabilities? I want market values on these. Everybody staying with me here? And the authors, Dan and David and I said the same thing. I want market values. Remember market values. That's a common mistake. People switch into historical and it goes nuts on you. Okay? What am I going to do here? I think I can get a really good estimate of the market value of the equity at any point in time for any company that's publicly traded. I can tell you what Papa John's was worth at the close of business today. How would I do it? Market price per share times the number of outstanding shares. That's what it was trading for. That's what it's worth. Now it'll be worth something different tomorrow. I know it's going to go up or down, right? But for that moment, that's what it's worth. Everybody agree? It's what it's worth. Now this is circular. Those of you who have some math background are going to say, wait a minute, you got a model. It's tautological because it's circular reasoning. We are using an estimate to estimate the same thing. And we kind of are. It's a weakness in the model, but it still works pretty good, okay? Because we're going to use the market's estimate of the value of the stock to get our own estimate of the value of the stock. It's not very good. Okay, but nobody has figured out a way around that yet. So what do we do here? This is going to be the market value per share. That's the stock market value, okay, guys? That's the market's estimate. We know what the market thinks it's worth, right? Finance types like to say, well, why don't we show the market value of the stock on a balance sheet? Big deal. It's just the number of shares, right? Outstanding times the market value per share. It's called market cap, by the way. When you get on Yahoo Finance or MS Finance, they're going to call it market capitalization, market cap. It's abbreviated. All they did was they took the market value per share times the number of outstanding shares. Okay? We're going to do the same thing. And I don't care. You can use market cap straight off of Yahoo Finance. Pick it up. But you're going to need the number of shares too. Okay? right? And then you're going to want to compare your estimate to the market's estimate. That is going to give me my estimate of the market value of the equity. Everybody good? That's it. What are we going to use as a proxy for the market value of the liabilities?
The book value that you like.
Yeah, we are going to pretend that the market value of the liabilities is approximately the same as the book value, which usually works okay. But you don't have to do that. What if you have a whole bunch of bonds and they're publicly traded? Can you find out what the market value is of those bonds? Hey, you can look it up. You know what the trading value is. There's nothing to it. If you have, let's say that they're not publicly traded, but you have a bunch of bonds. Could you take the current interest rate that you'd have to pay and discount those bonds back to now and get an estimate of what those bonds are worth? Absolutely. How about if you have mortgages? Could you take the current interest rate and discount those future cash flows on that mortgage back to now and find out what it's worth right now? Sure. When you do that, usually what happens is it doesn't make much difference in your estimate of market value of the stock, and you're done. So most people don't, okay? So we're keeping it simple here. But you can get a lot more sophisticated with this model. It just goes crazy. Well, you know how researchers are. PhDs love to do stuff for no reason. Okay, right? And we kind of do, it's true. Okay, anyway. So if I have, so everybody get this? By the way, what's a proxy? You know what a proxy vote is? When you have somebody else vote for you, you give them your vote, they vote for you, it's a substitute for you, right? Okay, what we're saying is the book value is a proxy for the market value. You like it? If you don't believe that's true, estimate the market value. Are we good? So it's easy. Where am I going to get the book value of the liabilities? Off the balance sheet, right? Just use the book value. And by the way, you can either use total liabilities or you can use just debt-bearing liabilities, liabilities that have interest, right? For now, let's use all the liabilities. You might get a different answer if you do it the other way. But if you're going to do it with only the debt-bearing, when you calculate your interest rate, use only debt-bearing to calculate your interest rate. If you use all the debt, calculate your interest rate based on all the debt. Guess what? It'll be a much lower interest rate if you use all the debt, because some of the debt is non-interest bearing. Like what? What debt does a company have that's non-interest bearing?
Unearned revenue.
Unearned revenue, there's one. Keep going. All the current liabilities except for what? Notes payable. Accounts payable, all the accrued liabilities, deferred revenue, absolutely. Right? Are there any non-current liabilities that are not interest bearing? Well, more deferred revenue, perhaps. Deferred income taxes, perhaps. Right, guys? Any long-term? Okay, there might be a whole bunch. Got the idea? In some companies, almost all their debt is non-interest bearing. So if you use all their debt, it makes the interest rate look real low, huh? Because the interest expense is just on whatever they have that was interest bearing. But here's the deal. If I only use the non-interest bearing debt, I'm going to have a whole lot less debt here, right, when I calculate. And I'm still going to have just as much equity. What's going to happen? My debt percentage is real small, but my interest rate would be high, right? So it changes the calculation, that's all. Okay, so let's use all of it for now. All right, as soon as I've got this, let's say it was $5 a share, and there's 1,000 shares, a million shares, whatever. What is that? Equity is now what? 5 million? Everybody agree if it's a million shares? Okay, so 5 million. I'll leave off the zeros. Okay, and then let's say our liabilities, when we go look them up, are, I don't know, 2 million. Got the idea? What would you do? Add 5 plus 2 and get what? 7 million. How would you calculate the weights? This is 100% of itself. I'm not kidding. And then what's this one? What's 2 sevens? 28%? What's 5 sevens? 72%. It's around there, right? Everybody got the idea? I'd probably go to a decimal place or two. Oh, students always ask me, how many decimal places? I could care less. I mean, you're making estimates here, you guys. But don't round it to, don't make that 0.3 and 0.7. That's probably a bit much. Maybe I'd add 1 decimal place to that, huh? So maybe. Okay, everybody good? So that's how I'm going to get my weights. Everybody got it? I just plug in here 28% for my weight of my debt and 72% for my weight of, my weight of my equity. Everybody good? What do we need next? Cost of the debt, maybe? How about that? How would you do cost of debt? What's the cost of the debt? Interest rate. Yeah, it's the interest rate. Which, by the way, what a finance type could do is they look at the bond rating of the company and find out what the interest rate is for that bond rating. And I would agree, if you're expanding the business, that makes sense because you're borrowing new money. But I think you ought to use the average interest rate of the company. I got this in that. I got it in paper too. Dan even bought off on it, right? Okay. You should use the average interest rate the company's paying if you're valuing the whole company. If you're valuing a new project, of course, use whatever they're going to borrow at, the rate they're going to be borrowing. Make sense? So it'll be the interest rate times what? Yeah, and please don't go look up new tax rates. It's the same tax rate. It's the same company, whatever you used earlier, right? For your cash flows, right? For your estimate of the cash flows, use the same tax rate, of course, because the government pays part of your interest for you. How about if I have $100,000 of interest and I'm in a 30% tax bracket? How much tax savings do I get? 100,000 on my tax return, reducing my taxable income by 100,000. I'm in a 30% tax bracket. What does that save me? $30,000 of taxes, 30% of it. How much did the interest really cost me? Well, 100 I paid of interest less the 30 tax savings is 70. Every single one of the expenses on my income statement cost me that number times 1 minus the tax rate. How much of your revenues do you get to keep? The revenue times what? 1 minus the tax rate. Government takes 30% of your revenue if you're in a 30% tax bracket, but they give you a break for every one of your expenses equal to 30% of your tax bracket. I'm sorry, equal to whatever your tax bracket is, in this case 30%. Okay? So there's nothing to this. How would I get my interest rate? Let's say that tax rate is 30%. So 0.3, I'm going to 70% is what it costs. How would I get my interest rate? No, but I like that. That's really good. That's sort of how we do it. Yeah, you're right. I like that. Although it's not it's the true return. So interest is true return plus expected inflation. That's where you were going, right?
Yeah.
And that's true. Plus risk, right? A risk premium. And we are going to use this. Okay? That's true. We're going to use it. But that's not what's going on here. What do we do? Interest expense is a great way to estimate it, I think. Take the interest expense off the income statement and divide it by what? No, the liabilities. I want a rate. I want a percentage that my interest is. Let's say my interest is $10 million, guys, and I have $100 million borrowed. Got the idea? I would take, by the way, my average debt here. You know why I do average debt? Finance types always like to use ending things for their ratios. Accountants like to use averages. It doesn't make any difference whatsoever. Unless what? What if I started with no debt and now I have real high debt? Probably ought to use the average, don't you think? Probably really a weighted average. If the debt didn't change much between the beginning of the year and the end of the year, who cares? Use the ending. Make sense, guys? But let's say my average debt is $100 million and I have $10 million in interest. What's my interest rate? 10%. It's just the amount of interest you paid divided by the average debt. Does that make sense? That's what your interest rate is, right? Wouldn't you take your $100 million debt times the 10% to get the 10 interest expense? So if you wanted to estimate what your interest expense was, if you wanted to estimate what your interest rate is, percentage, wouldn't it make sense to take your interest expense and divide it by the average debt? Everybody staying with me on that? That's what we said in the paper too. It is. Okay, it's there. So here's the deal. If I am paying 10% and the government picks up 30% of it, what's my after-tax interest rate? 7%, right? Whoops, did it wrong. I'd have 10% here times 1 minus 30%, right? What do I have? 7% is my after-tax cost. KD is after-tax. Everybody got it? 10% times 1 minus 30, same thing there. But why did I write it twice? I don't know. Okay? 7% would be my number. And where does that go, guys? It's KD up here, cost of debt. Now what I'd have is, what did I have? 28% debt? So this would be 28% times, what did we say it was, 7%? I'm not kidding. 28 times 7%. That number's not going to mean anything. It's just going to be the weight of the debt times the cost of the debt. Okay? Let's go for weight of equity. What do we have? 72? I'll put that in there. 72%. We already had that one. Times what? Well, the cost of the equity. So I guess we have to do that one last. Okay, that's the next one. What do you want to do for cost of the equity, you guys? KE. You know, the part of the model that we haven't said anything about yet, which is the most important part, is what? This is WACC and CAPM, right? What's CAPM stand for? WACC is weighted average cost of capital. What's CAPM? Capital asset pricing model. Got it. This is finance's Bible, right? Okay? The capital asset pricing model. This is an estimate for how much the shareholders should expect to earn. By the way, is there taxes on this one? You're going to get a tax impact? Do you get a tax deduction, right? Deduction on your tax return for dividends paid? No. Do you get it for interest paid? Yes. It's a huge difference, isn't it, right? And certainly for market appreciation, you don't get a deduction, right, on your tax return. Okay? So there's no taxes in this one. What is the formula for CAPM? Now we go back to this stuff up here, so that's good. It's got it up in mind. What is the deal here, you guys? Capital asset pricing model equals what? You can look at the formula there. It's all right. What is it? Risk-free, so it's the risk-free return plus the beta for the company, that's the company's beta, times the market risk premium, right? Which this risk premium here, it's the premium that this company, that you have to get for this company because of their riskiness, okay? What's the formula for the risk premium? Return on the market, so that's, okay, that's what we expect to earn on the market as a whole over time, minus the risk-free, okay? All right, that's the risk premium. Now, what are these things? Okay, the risk-free is how much you could earn on an investment without incurring any risk. Does that sound good? We only have one thing we could use as a proxy for a risk-free investment. The U.S. has by far the biggest military in the world. And we are one of the richest countries in the world, even in spite of that. In spite of things, right? Extremely wealthy. Guess what is considered worldwide a risk-free investment? U.S. Treasury bills and U.S. Treasury bonds. You're investing with the federal government. Guess what? They're going to pay you. They'll print money if they have to pay you. Everybody got the idea? You're going to get paid. No, unless the country ceases to exist or something. Got it? Pretty low risk investment, huh? So that's what we use as a proxy for risk-free, because there's really no such thing, right? I guess. And what I suggest you use, I got this one too, is the T-bond rate, okay? Treasury bonds. I like a 30-year. You know why? Because that's the longest one there is, and we are investing forever, theoretically, right? We're buying cash flows forever, so we use the longest federal rate there is. Now, if you were only going to invest for a couple of years in a project, let's say you invest for 5 years, what would be better to use? How about a 5-year Treasury bill? All of them may have different rates. Got the idea? The 30-year is higher right now because people don't expect much inflation now, but they think someday we'll have some inflation, right? 30 years higher right now. I think it works better anyway in the model, actually I do. And people have disagreements about this stuff, you guys. It's just a model. It's an economic model, right? You know, you can do whatever you want, okay? So, 30-year Treasury bond rate. We can look that up in the Wall Street Journal or online in Yahoo Finance, and we will. Everybody like it? That's the proxy for it, okay? So that's risk-free, and that's going to be, guess what? It's going to be the same risk-free in both places. Please don't give me two different ones. I'll think you're nuts, okay? All right? You're making life difficult. What's RM? That's not risk-free. It's not rate for the market. It's the return on the market, we call it, okay? So it's the return that the market expects, okay? You got risk-free, the risk-free rate, and the market rate, okay? Or you can look at it. What do we mean by market? Listen to this one. It's what, in your opinion, the market is going to earn forever. How much is that? Well, forever for me has been since I started investing when I was about 30 years old, right? Way too late. Say 29, right? When I started investing, you guys started, okay? Do that. As soon as you start making some money, invest. You'll double your money one more time than I did, okay? That's a lot of money that I feel away. Okay, anyway, so if in the course of my lifetime, if I look at what happened, the market's earned about 12%. So what do I think the return on the market probably is? 12%. Right? Over the course of your lifetime, it's a slightly different number. But you know what? It's 12 or 13% over the last, I don't know, 50 years, 30 plus years. Everybody got it? Okay, 50 something, 60 years. Really? Is that long? Since the depression. Okay. It's like that. And you know what? When the market is where it is right now, between 16 and 17, we're back on track for that. When it took the dip down to about 8, the market went down to 8 all of a sudden. Oh my, we're not earning that much anymore, and now it just comes right back up there. That's because Obama's a wonderful president. No, it has nothing to do with the president, whichever one it was. Right? When George Bush was president, the market was way overvalued. Every stock that we were valuing, like using this model, was selling for more than it was worth, and all the students were saying in the MBA, right? They're all saying, well, this model doesn't work. The stock's worth far more than that. I'm like, no, it's not. And they say, well, don't you buy stocks? Well, of course I do, because I don't think it's going to go down. It keeps going up. But I think it's overvalued. Guess what? Auto fell out of it, right? Way too much. It went way too far down. So then we're valuing all the stocks. Guess what happened? They're all worth more than they were selling for. It's a great time to buy. I kept right on buying. I always buy. I just buy and buy and buy and buy. Because I don't know whether the stock market's going to go up or down, do I? But I know that over time the market earns what? Maybe 12 to 13%. You say 11 to 13%, I don't care, over time. You want to earn 1 or 2 on a savings account? You want to earn 5 or 6 in the bond market? Or do you want to earn 12 or 13 in the stock market? Wow. And then you talk about diversification of risk, buy enough stocks across the market so you get whatever the market earns, so you're not at risk for anything other than whatever happens to the market. Wonderful investment strategy. Just keep investing. Dan and I were talking about that today. We should start a brokerage firm, a money management firm, and take 1% of people's money, and we just pretend like we were picking stocks, but we just buy the S&P 500 for them, because you can buy the mutual funds and then take 1% of their wealth to invest in the S&P 500, which they could have done for themselves for free, right? But we take 1% every year of their wealth. It'd be great. Don't do that. That's after that. Really do something for the money. Okay? So really do something for the money. And there are things you can do for the money too. You get preferential returns, that sort of thing. That's all right. Okay, anyway. So you know what this model is doing is this up here. It's coming up with that interest rate because we've got risk-free here, right? These two are risk-free. True return plus expected inflation plus a risk premium. This part over here is risk premium. Now, the market's risk premium would be what? Let's say the market, let's just pick 12%, and you guys are going to decide for yourself what number you want to use, or maybe on a quiz I'll tell you what number to use, okay, or a test. Let's say we do think this is 12%. What's the risk free? Right now it's between 3 and 4. It's really low, okay? You guys will be looking it up. I haven't done it for a while, so I'm not sure where it is, but it's somewhere between 3 and 4, which means that expected inflation plus true return is 3 or 4. There's almost no expected inflation, huh? Because remember, true return was 2 to 3%. Remember that? Expected inflation must be about 1%, huh? If this number down here is somewhere around 3 or 4, if the risk-free is, whoops, I wrote the wrong one there. I apologize. Dangerous. Risk-free, the 30-year Treasury bond rate is around 3 or 4. Let's assume it's 4%. And then let's assume the risk return on the market, we think, is 12% over time. What's the risk premium we have here, you guys? We told you in the paper risk premium is somewhere between 5 and 7%, or 5 and 8%, 6 and 8. Did we tell you that? Yeah, right now people are thinking it's probably around 8%. It should be the same over time. It's the extra return you get for being in the market, right? Risk-free would be 4%, and you get another 8 for being in the market. Well, this is how it works. My return on the market's 12. My risk-free is 4. The difference between them is my risk premium. If I just give you the risk premium, just use it, huh? Now, what's beta? Beta is a proxy for the risk of the stock, right? It's how the stock moves compared to the market. So what we do is, and you're not going to have to calculate this, we can look them up. They're on Yahoo Finance, different people calculate them. They're on MS Finance. By the way, when you look at different financial services, you get different betas sometimes. Yeah, there's a disclaimer, you bet. And what's the deal? They use different time periods. Some might be doing daily returns, some might be doing weekly returns. And be different, right? Show different variability, right? Some might use more years or more months or something like that. Some might use a shorter time span. Okay, so you might get different betas depending on what's going on with the company. That's okay, they're just estimates anyway, riskiness. Okay? What it is a covariance of a particular company's return to the return of the market as a whole. So what we do is we standardize, stack classes, we're stressing here a bit, huh? We're standardizing the return of the market at 1.0. So the market's variability compared to itself is none. So it's 1 to 1, right? 1 to 1. The market line is 1, right? It's just 1. So the covariance of a particular stock to the market is how much the stock varies compared to the market. Does that make sense? I'm really horrible with graphs, but I'll give this a tiny shot. Looks something like this. Over time, the market is doing something like this, okay? Boy, is that going up fast. Okay, anyway, say the market's doing something like that. Your stock might be doing this over time. What does that mean? Sometimes this is time, this is dollars of value, right? What's happening? Sometimes you're outperforming the market, sometimes you're much worse than the market, right? You're bouncing all over the place, which means your incomes are bouncing all over the place, your dividends are bouncing all over the place. You got the idea? You're bouncing around. That's more risky than the market, we think. Why? What if you have to sell at the low point? You lose money, wouldn't you? Versus if you were just invested in the market that's sort of stable in between there, what would happen? Well, you have less risk. The market has less risk than you do. Your beta would be higher than the market's. We standardize the market at 1, and then we look at your beta compared to theirs, okay? Or your covariance relative to them. What if I had a stock, though, that was more like this? Well, this is hard to draw because I made the market so stable. What if it's like that in between there? Now what would you think? Less risky than the market. So guess what? If you're more risky than the market, your beta is more than 1. What if your beta is 2? You're pretty risky. You fluctuate twice as much as the market. What if your beta is 3? You're real risky. Got the idea? You're just bouncing all over the place. But do you like risk or not? If you like risk, buy it. It's okay. What if your beta is less than 1? Now you're numbers. Now you're McDonald's. What's happening? You're big and people always buy your stuff. It's wonderful stuff. But they're buying your stuff, right? Okay? When times are good, people buy it. When times are bad, people buy it. People always buy it. They always buy a lot of it, right? Extremely stable. More stable than the stock market as a whole. Okay, got the idea? What if you're a small drug company? Oh man, what if you're a small toy company? Your beta is astronomical, huge, right? High tech, small ones. What about really big drug companies like Pfizer or something? Their beta is pretty low. Why? They have a whole bunch of drugs that they spread the risk over, right? And some aren't working well, the other ones are working well, and some are going up, some are going down, right? So then they kind of create a market for themselves. Does that make sense? Same with high-tech companies. Same with really big toy companies, too. Although there it's pretty tough to get a low beta in the toy industry. Because you know what? The toy that's popular for Christmas is the one where the toy company makes all the money. And all the other ones, they're just have a rough year. It's crazy. But think about it. Think about your brothers and sisters or when you were kids, like, or your nieces and nephews, children, if you have children yet. Okay, what's the deal? They want all exactly the same thing. And you know what? My grandkids get it. And so everybody else's grandkids have it. Oh, wow. Yeah, so you know what's the hot thing. Anyway, and all that goes into risk, guys. Okay, I can't stand looking at that because it's so bad, so I'm going to get rid of it. I don't want any economist ever to see that. I shouldn't be putting these on recording, should I? Okay, anyway, so they laugh at me enough already. Go back to the classroom. All right, anyway, so that's going to be my beta. So you'll look up the beta. Let's say my beta is 1.0 first. That means my risk is exactly the same as the market. What would cap it be? 4% times what? 1 times 12% minus 4%, or 1 times 8%. What would 4 plus 8 be? Cap M would be 12%, which of course is the return on the market, isn't it? That's because your beta is 1. Let's make my beta 2. Let's try that. What if my beta is 2? Ah, crap. That's a technical term. Okay. Risk-free plus beta. There we go. All right. What if my beta is 2.0? Now what do I have for cap in? What happens to it? Look what happens here. I don't double the 12%, do I? What do? I just double the risk premium, don't I? What's my risk premium going to be? 8% times 2 is 16 plus 4, what do I have? Cap M of 20%. Well, 20% return, weighted average cost of capital, that's a risky company, isn't it? 12% is the market. Need 20 now. Everybody got the idea? Let's make my beta 0.5. Let's try that. What would I have over here for cap M if it was 0.5? I'd have 0.5 times 8% would get 4, and then I'd add the 4 risk-free, and I'd have 8%. Everybody got the idea? There's nothing to this. So let's assume my beta's 2, and I've got a 20% weighted average cost of capital for valuing my company here. Okay, so let's try that. What would I do with that now? Now that I have cap M, what did I just calculate? A, that's it. So this is 20%. So calculate that one for me. What's 0.28 times 7% plus 0.72 times 20%? What I recommend to you doing it mathematically is don't leave them both percentages and don't make them both decimals. You might get your decimal place in the wrong place. Leave one a percentage, make the other one a decimal, and multiply them together, and you still have a percentage. You like it? So take 0.28, say, times 7%. 0.28 times 7, what is that? Doesn't mean anything, but what is 0.28 times 7%? Here, 0.28 times 7%. I pointed this like you could see what I'm doing. Sorry about that. 0.28 times 7%. What's that? Or 28% times 0.07, however you want to do it. What percent is that? Let's go, guys. How much? How much? Yeah, 1.96. So 2.0. 2.0% for this one, good enough? Everybody like it? It means nothing. It's a weight times a rate, right? Weight times a percent. Doesn't mean anything. But we're going to use it, okay? What's 0.72 times 20%? It's like 14% to me, huh? 14.4%? Okay, what's whack? 2.0 plus 14.4. I need to, on every dollar of assets, I must earn 16.4%. If I do, that will keep my equity holders happy and my debt holders happy. You like it? That's all the model's doing. I only want investments that will earn me 16.4%. If I earn less than that, the value of my stock will go down. If I earn more than that, the value of my stock will go up, but my shareholders won't be very happy if I earn a lot more, because the only way I can earn a lot more is to take more what? How do you get more return? More risk. If you invest in a company and you expect them to take a 16% risk and they start taking a 40% risk, what do? Sell your stock. You're upset. Or try to get rid of the board of directors or get rid of the officers. I'm not kidding, right? You want them to do what they said they were going to do. Okay? Everybody got the idea with this thing? So this is the amount you've got to earn on your assets. Yes, sir?
And this is all based on a year span?
Oh, you mean in terms of the rate? Oh, every year. They have to earn 16.4% every year. I got you. Yeah, every year. Okay? All right, now what do you want to do? Take your estimated cash flows, right? So I guess we'd have to have that. How many cash flows do we have? Got somebody make up a cash flow for me. Net income before tax, we said 30%, 1 minus 0.3, let's just make up 1. Let's say our net income before tax, how much debt do I have? Anybody remember? You guys are no help. I said I had debt of $2 million, okay? I have equity of $5 million, $7 million total assets. Okay, so let's say on that I'm making, on 7 million total, I'm making 200,000, okay, on my 7 million. This is awful, okay? And So then, well, let's make it 200 here, wrong spot. Make it 200. And then let's say that I have a 30% tax bracket, okay? So that's going to be 200 times 0.7, right, for 140? Everybody agree with that? But then let's say I've got a lot of depreciation. I have new assets. So this is 220. So what would you do? My depreciation amortization is 220. So I've got 200 times 0.7 is 140 plus 220. How much is that? 360. So I'm generating $360,000 on a year on my $7 million of equity. Everybody agree? Okay. All right. Now what's my WACC? So 16.4%. Just divide it in. That's all we're going to do. Take the 0.164 and divide it into 360. 360,000. We're going to find out my estimated market value of the assets. How much is that?
2195.12.
So 2195? They're worth 2,195,000? Oh wow, now I'm in trouble. The market thinks they're worth 7 million. I think they're worth 2,195,000. What would that imply? The market thinks there must be what? Either I calculated wrong or the market calculated wrong, but a lot of people in the market are calculating all the time, right? Boy, that's a big difference. What must they think there is? Growth in the cash flows. They think there's a lot of growth in the company, and next time we'll calculate the growth, okay? All right, guys? So do this, okay? Try to do the problem I gave you, and then try to do target and Young. Is that what I suggested? Let's finish this though. What do? Take away your estimated market value of the liabilities. How much was that? I screwed up this example. What was the estimated market value of the liabilities? Was it 2 million? Yeah, it was, wasn't it? So what's my estimated market value of the equity? At least you get the calculation. 195. Way to go, Keith. Okay, that's what you do. You get when you do them off the top of your head. 195. How many shares did we say there were down below? Is 1 million shares? What's 195 divided by 1 million? This stock should be selling for 19.5 cents per share. It's a penny stock. Oh, well, anyway. All right, and the market thinks it's worth how much? $5. You know what? That's a lot of growth, but it's not an infinite amount of growth. Must be a new startup company that can really take off and control the value, right? Not overvalued. It's valued way over our calculation because the market thinks there's a lot of growth. And we can do that growth in about, I don't know, 30 seconds if we wanted to. But I guess you don't really. No, we have to go to quarter after, don't we? Or you put stuff away. It's only 10 after. You don't really want to leave. Let's do growth. Let's do growth on this one. What changes for growth? It's really simple. What changes for growth? You almost got away with it. What changes for growth? What do we change in our formula? You guys pick that up when you read this thing? What do we do if we add growth to it? Well, here's the way to think about it. When you look at this right here, the estimated cash flows divided by the WACC is the estimated market value of the assets. But what if I got more cash flows from growth? What if I got 10% growth a year? What would happen? My cash flows right now are 360. If I get 10%, what would I have the next year? 360 plus 36, right? Everybody agree, 396? And then what would I have the next year? I'd have almost 40 more added to that. I'd get close to 440, wouldn't I? And then the next year, I'd have 44 added to that. Everybody got the idea? Forever, right? If I have 10% growth forever. But remember, we only care about the cash flows for the first 20 years or so, right? So you estimate what the growth rate is out into the future. So what I could do is I could say, okay, what's this stock worth at 5% growth? And here's how I do it, you guys. I would take, you guys will tell me what the numbers were, won't you? I will take my estimated cash flows, which were 360, was it? Yeah. And I will divide it by WACC minus the growth rate. I'm not kidding. So my growth rate is what? No, the growth rate. Or I'm sorry, my growth rate, I said 5. I'm lying. What was my WACC? 16. Thank you. 16.4% minus 5. Here we go. Take 360, and really what I should do is I should put 360 times 1 plus the growth rate, right? But it makes the math annoying, so this is a rough approximation. Just do it this way, okay? Makes the math a little harder because you have the G in both places and you have to solve for it. It's not that big a deal. What's the difference between 16.4 and 5%? Okay, now let's get this intuitively. If I need to earn 16.4 to keep the debt holders happy and the shareholders happy, but I get 5% from growth, might it be all right to get 5% of the cash from growth and the rest comes from the earnings? That's all it is intuitively. Got it? So if I get 5% growth, I only need to earn 11.4. Okay? So then what I do is I would divide the 360 estimated cash flows times WACC minus growth, and that'll give me my new estimate with growth, right? With growth now of my market value of the assets. How much is that? Anybody do it yet? What's 360 divided by 0.114? 3157. So we're getting a little closer, aren't we? Okay? And then what would I subtract from it, everybody? Estimated liabilities. Estimated market value of the liabilities, which we said was 2, didn't we? So now what does that give me as my estimated market value of the equity? 1157. What would I divide it by? 1 million outstanding shares. And what do you get per share? Now I got $1.16, don't I? I'm getting closer to their $5 now, huh? With a 5% growth. Boy, this growth is big. How about if I want to calculate exactly what it is? What could I do? Actually, I screwed this up. I should have taken this times 1.05. I apologize. The first one, get the first years. So this would be a little higher than that. Okay? All right? This one would be a little bit higher. What do I do if I want to estimate what it really is? Take a look at this. Estimated cash flows. How much growth does the market think there is? WACC minus some growth that the market thinks it is will give me what? My 360 estimated cash flows divided by 16.4, you got it, 16.4% minus growth, right? But you know what I know? I know what the market thinks the assets are worth. What does the market think the stock is worth? $5 times 1,000 shares was how much for equity? It's 5 million. So what we got is 1,000 shares here times $5 is the equity, which is 5 million. And then what do we have for liabilities? We had 2 million, didn't we? So what did that give me for assets? I just wasted some time, didn't I? We're out of time and I'm wasting time. I could have just picked up 7 million the market thinks it's worth, right? I already calculated that for my weights. Can you solve for G, you guys? There's nothing to it. Some number, 16.4 WACC minus G, divided into 360 is 7 million. How would you get it? Take 360 and divide it by 7 million. 360,000 divided by 7 million. So what's 16.4 minus growth? Somebody want to do that real quick? 360 divided by 7,000 is what? 360,000 divided by 7 million. $360 divided by 7,000. 0.5%? Okay, 5%. 5.0%. That sounds better. Okay, so what's growth? 5% divided into 360 is 7. Is that right? Okay, or 7 times 5% is 360. Both ways. Did we do the math right? So 16.4 minus growth is 5%. What's growth? What is it, you guys? 11.4%. Boy, this is a startup company, right? It's going to grow at 11.4% forever. It doesn't have to forever. It could grow really fast in 40 years and then later go at a lower rate. Okay? Give it a shot, you guys. Try and work this problem. We'll do the problem real fast next time, and then we'll try to do a real company. Try and get target down. Young. The what? Oh, the market return you have to come up with. You want to use 12, 13, 11? I don't care.
That's what I got stuck on. I was like,
oh, yeah, but he's got on purpose. Yeah.
and then I'll get different answers.
Yes. I don't think I told you what to use. So it's faster, everybody use 12. When you do the problem, use 12% as your return to market.
Crumbled mine up because I thought I didn't have that, and then,
I can't find it, I can't find it. Whatever you think it is. It's how you use the judgment. Where are these guys tonight? Sarah, did somebody else come in? Didn't make a quiz?
I need to get this way. You said the average was 10?
Yeah, right. Why wouldn't I do that? I should have read them off to you guys. Remind me next time we'll do it. Okay.
here, question, on the last one. Are we supposed to calculate the present value and then add it up?
Yeah.
Started doing
Calculate
that.
each one of them, right? You get the present, you get the future value, not present. Future value of each one, but remember, this one is gonna be, this is the first 10 years, and then you have to compound it for the other 30 years.
And it's subtract.
At all these different, different interest rates that are there, right? I left in the same part of it and I switched it now. So what I do is I have this at the end of 10 years, right? And then I compound it for another 20 years to get to the end of 30 years, right? Okay, and then I compound whatever that is at 8% for the last 10 years. Then I do this one, I compound it for 10 years, but that would only compound for another 10 after that, right? And then I compound it for 10 at 8, and so I can add them together, right? And then the third one, I'll just compound it 12%, but now I'm at the end of the 30 years, and then I'll compound that at 8%. And then the fourth one, it just compounds at 8%, right? And then I add all four of these together, and that's that answer. Right, it's real big. Okay, and then what I do is I figure out how much will that payment you might have done.
Yeah. What, how percent of us off?
Yes. You want to get the other, it's only one. And we'll do it in class. Yeah, it's similar to one we did, but it's a little bit different. Oh, a little bit different. So hang in there, keep working on it. You on that quiz? And you study, did you? Not enough. Not enough. You having fun? College life is wonderful? I don't know why I worked so hard in high school, so I had to put up with this now. You'll be fine. You can get it. We're going to turn you into a machine now. All right, let's see if this thing actually worked. Where's my recording? Did it record anything?